Dubai has always sold a very specific dream. Golden visa glamour, year-round sunshine, and, most famously, a promise that neither you nor your company would ever file a tax return. For decades, founders from London to Lahore landed at DXB with little more than a passport, a free zone license, and the comforting knowledge that the taxman stopped at the border. That certainty ended in 2024. For the first time in the UAE's modern history, a federal corporate income tax, 9% for most firms and 15% for the world's largest multinationals, became law. LinkedIn feeds caught fire. News anchors asked whether the Gulf miracle had cracked. And entrepreneurs who had never uttered the words Form CT01 suddenly found themselves Googling capital allowance schedules at 3 in the morning. Tonight we're going to unpack what changed, who now pays, whether expats and companies are really packing their bags, and where the money might run next. By the end, you'll know whether Dubai is still a low-tax paradise or if the shine has finally dulled. Until last year, corporate income tax in Dubai was either zero or sky high, depending on your industry. Oil producers could pay up to 55% and foreign banks 20%. But everyone else, coffee shops, fintech startups, global headquarters, paid nothing to the federal treasury. That changed when the UAE signed Federal Decree Law No. 47 in December 2022. The legislation introduced a standard 9% rate on taxable profit above 375,000 dirhams, roughly $102,000. Anything below that threshold remains untaxed, to spare small businesses. The law also pledged that, beginning in January 2025, multinationals earning more than 750 million euros worldwide would face a top-up to 15%, bringing Dubai in line with the OECD's global minimum tax plan. Why surrender the zero tax headline? 3 reasons explain it. First, global pressure. 136 countries had already committed to the OECD framework, and the UAE risked landing on blacklists if it refused. Second, diversification. Oil still funds Abu Dhabi, but Dubai runs on services and tourism, both of which need predictable public revenue. Third, credibility. Sophisticated investors trust jurisdictions that publish clear tax rules more than those that rely on informal handshake exemptions. Overnight, about 90% of mainland companies, businesses that had never filed a federal return, were scrambling for accountants.
Let's translate the new code into plain English. Mainland limited liability companies now pay nothing on the first 375,000 dirhams of profit, and 9% on everything above. They can carry losses forward to offset as much as 75% of future taxable income. And group companies can file as a tax consolidated unit if they wish. Free zone entities keep the famous zero, but only if their income is qualifying. That means transactions strictly within the free zone world or with customers outside the UAE. The moment a free zone firm sells even a modest consulting package to a client on the Dubai mainland without a ring-fenced structure, the 9% rate applies to the entire year's profit. Multinationals above the OECD threshold cannot hide behind local loopholes. They will owe 15%, no matter how many holding companies stand between Dubai and Delaware. Freelancers and sole proprietors follow the same playbook. If they incorporate an FZ LLC and limit their billing to overseas customers, they remain at zero. If they begin serving mainland clients, they shoulder 9%. Individuals still enjoy zero personal income, capital gains, and inheritance tax, so salary earners see no change at all. A new anti-avoidance rule shadows these numbers. The Federal Tax Authority can ignore transactions lacking real economic substance. Shell offices with no staff, for example, risk back taxes plus penalties of 50%. What did the first year look like on the ground? Dubai's flagship free zone, the Multi-Commodities Center, processed 9% fewer license applications in the first quarter of 2024 than in the same period a year earlier, the zone's first decline since 2017. Meanwhile, Riyadh's King Abdullah Financial District
reported a 46% surge in foreign business licenses, and half of those new arrivals listed Dubai as their previous headquarters. Office absorption tells a similar story. Grade A vacancy in Dubai crept from 7% to 11% in 18 months, softening, though far from empty towers. On the financial markets, Dubai's main share index fell just over 1% on the day the 15% ruling was confirmed. Amar Properties and Emirates NBD both slid, but neither crashed. And what about the people behind the spreadsheets? A Gulf talent poll of 1,800 white-collar expats found 12% actively considering relocation because of taxes and rising living costs. 2 years earlier, only 4% said the same. Their short list of alternative cities: Riyadh, Doha, Singapore, and Lisbon. Those numbers feel meaningful, yet they do not spell mass exodus.
Maria, a Portuguese marketing agency founder, illustrates the mixed mood. Her Mainland LLC cleared 1 million dirhams last year. Under the new law, she now owes about 56,000 dirhams, or roughly $15,000. She calls the bill annoying, but insists rent increases hit harder. Her downtown apartment climbed 22% in one lease cycle. Arun, an Indian fintech engineer, heard the same numbers and made a different choice. Compliance costs plus 9% tax nudged his 5-person team to relocate to Riyadh, where Saudi free zone incentives still guarantee zero corporate tax for half a century. He now commutes to Dubai once a month for client meetings. Then there is Sarah, a British crypto YouTuber. Personal income tax remains zero, and her profit seldom breaks the 375,000 dirham threshold. For her, the new law is a non-issue. The moral is that impact depends on margins, sector, and tolerance for red tape. Businesses are not passive observers. Some ring-fence mainland sales into a separate branch, protecting their free zone entity's 0% status. Others downsize fancy Dubai offices, shifting non-client staff to cheaper Sharjah or Ras Al Khaimah. A few route intellectual property royalties through Bahrain or Mauritius, leveraging older tax treaties. And many are simply raising prices to cover the 9% hit. Accountants warn the era of paper shuffling is narrowing. The UAE's economic substance regulations already mimic OECD anti-profit shifting rules. A company with no payroll, no board meetings, and no physical desk will struggle to convince auditors that its profit really belongs in a zero-tax shell. On one side of the ledger, Dubai still offers zero personal income and capital gains tax, a corporate rate less than half the OECD average, modern infrastructure, and door-to-door flight access to 2/3 of global GDP. On the other side sit new compliance costs, the possibility of VAT doubling from 5 to 10% later this decade, and jaw-dropping rent increases, up 24% downtown in a single year. Dubai has become less like a Caribbean zero-tax island and more like Singapore, low tax rather than no tax, balanced by logistic efficiency, personal safety, and lifestyle perks. For most small and medium enterprises, 9% remains cheaper than uprooting staff, spouses, and school-age kids. Some capital has moved. Saudi Arabia's offer of zero corporate tax in designated zones and guaranteed access to Vision 2030 contracts is irresistible to multinationals chasing government business. Qatar, flush with World Cup infrastructure, pitches a similar 0% promise through its financial center. Bahrain provides low costs and no corporate levy, luring fintech support desks. Farther afield, Lisbon and Athens still tempt remote-first entrepreneurs who prefer an EU passport over desert heat. Malaysia's Labuan jurisdiction markets an offshore rate as low as 3%, paired with easy access to Asian time zones. Early statistics suggest a regional reshuffle but not a flood. Dubai's premium office occupancy dipped a few points, but Saudi villa rents jumped 13% as newcomers arrived. The Gulf rivalry is heating, not collapsing. Looking ahead, most analysts expect the UAE to nudge VAT upward, but leave personal income tax untouched. Too many voters and investors would revolt. Free zones will keep their zero rate, yet regulators will demand real substance.
Audited payroll, local directors, perhaps mandatory R&D spending. Saudi incentives may stay generous until oil dips below $45 a barrel, at which point Riyadh could mirror Dubai's 9% compromise. And the OECD is likely to expand its 15% minimum tax sweep to mid-tier multinationals, closing the gap further. Put simply, the game is shifting everywhere. Dubai is no longer the Wild West frontier of zero tax, but it remains a polished, globally connected hub where 9% often buys you more certainty than cheaper promises elsewhere. Dubai has nudged its open door from fully wide to half open. 9% will sting profitable firms, but many entrepreneurs still prefer that to 23% in Europe, 25% in Hong Kong, or 30% in India. The city's real competition comes not from London or New York, but from Riyadh, Doha, and Manama, all eager to prove they can offer equal sunshine with fewer rules. So is the dream dead? Probably not. Is the playing field shifting? Absolutely. And if you run a lean, high-margin operation, your accountant just became your new best friend.